Picture this. A company founder started a business 30 years ago when the shares were worth literally pennies on the dollar. Today, those same shares are worth over $50 million. And if that founder sells even a tiny percentage of them, they are hit with a massive capital gains tax bill that would make your head spin, but they don't sell. Instead, they do something else entirely. They use a strategy that most retirees have never even heard of. A strategy that lets them spend millions of dollars without paying a single cent in federal income tax. Oh shit. It sounds like something out of a movie, but it is totally legal, and it is happening right now in May. Naunsenin Arshadil, it is called the buy, borrow, die strategy. According to a recent Naunsenin Arshawu from the Yale Budget Lab, this is one of the main reasons why the wealthiest people in this country pay almost zero income tax. I am going to show you exactly how it's done, but I need to be real with you. For many of you, this might not be the right move. Still, knowledge is power. And you might find pieces of this puzzle that can completely change your financial trajectory. Let's jump into it because this strategy sits on 3 ordinary rules of the tax code that become a superpower when you stack them together. The first rule is one everyone knows but few truly leverage. You only pay capital gains tax when you sell the asset. If you buy 1,000 shares of a stock at $50 a share, that's a $50,000 investment. 20 years later, those shares are worth $500 each. So your 50 grand has turned into 500,000. You have a $450,000 gain. But as long as you don't click that sell button, the IRS can't touch it. The tax code calls this a realization requirement, and it is the foundation of massive wealth accumulation. Rule number 2 is even simpler. Borrowed money is not taxable income. If you go out and borrow $200,000 for a house or a car, the IRS doesn't say you made 200 grand that year. This is true for a mortgage, and it is equally true for a loan backed by the stocks in your investment portfolio. Rule number 3 is the kicker. When someone passes away, the heirs get what is called a step-up in basis, that $50,000 stock that grew to $500,000. If the owner dies without selling, the heirs inherit it at the $500,000 value. That $450,000 gain just vanishes into thin air. As far as the IRS is concerned, under Section E10 of the IRS Code, this applies to stocks, real estate, and even rare art. Now we need to talk about which accounts this actually works for, because this is a mistake I see people make all the time. There are 3 types of buckets for your money. Bucket 1 is your tax no account, your regular brokerage account at Schwab or Fidelity, where you pay taxes on dividends and gains every year. Bucket 2 is your tax later account, like a City OK or a traditional IRA where you get a break now, but pay when you withdraw. Bucket 3 is the tax never account, the legendary Roth IRA where you pay now and never pay again. The buy, borrow, die strategy only works with bucket number E. The regular brokerage account. I've seen comments from people thinking their heirs won't pay tax on a City OK if they die before withdrawing. That is absolutely not true. That money is still a tax time bomb for your kids. The whole strategy depends on having real wealth in a taxable brokerage account where the step-up in basis applies. So here's how the wealthy put these pieces together to live for free. Instead of selling their shares to buy a yacht or pay for a luxury retirement, they borrow against them. The tool they use is called a securities-backed line of credit, or an S-block. Major banks like JP Morgan and Merrill Lynch love these because you pledge your stocks as collateral. They might give you 50 to 70% of the value of your stocks as a line of credit, and if you're holding boring stuff like treasury bonds, they might give you up to 90%. But here's the catch for Naunsenin Arshadil. The interest on these loans is tied to SOFR, the Secured Overnight Financing Rate. Right now, SOFR is sitting around 5%, and banks usually tack on another 5% or 5%. On top of that, so your line of credit might cost you between 5% and 5%. Right now, there is no fixed repayment schedule and no maturity date. You can carry the loan forever, and because the money you get from the bank isn't income, you don't owe a dime in tax on it. In fact, if you play your cards right and itemize your taxes, you might even get a tax break on the interest. But here's where the strategy really bites. When you pass away, the loan is repaid from your estate and your heirs get that step up. In basis, the estate turns around, sells the shares at the new higher value to pay off the bank. And because of the step up, there is zero capital gains tax. Let's look at a real example. So you can see the math. Imagine you bought a portfolio 30 years ago for $500,000 and today it's worth $3 million. During your retirement, you borrow $1 million against it to fund your lifestyle. You pay the interest as you go, but you never sell a single share when you pass away. The stock is worth $1 Your heirs inherit it at that $1 dollar basis. They sell $1 million of stock to pay off the loan, and they pay zero tax. They keep the remaining $1, and that massive gain you made over 30 years was never taxed. Not once. The Yale Budget Lab calls this completely escaping taxation. And they aren't kidding. Now, this has been a huge debate in Congress lately, but the OBBBA legislation recently increased the estate tax exemption to $15 million for individuals and $30 million for couples. What that means for almost everyone watching this is that the government isn't coming for your estate anytime soon. The big downside of holding assets until death has basically vanished for most Americans. But I want to talk about something that surprises most retirees. You do not need to be a billionaire to use a version of this tax-free life. The befintlighting capital gains bracket is way more generous than people realize. For a married couple in Nyansinin Arshideo, you can have nearly $97,000 in long-term gains taxed at befintlighting federally. The smart play for a lot of people isn't actually borrowing and paying befintlighting interest. It's slowly harvesting your gains in years when your income is low, paying zero tax, and resetting your basis higher. You get the same benefit as the billionaires but without the risk of a bank loan. And speaking of risk, we need to talk about the dark side because this isn't all sunshine and tax-free checks. Risk number 1 is the dreaded margin call. If you borrow against your stocks and the market pulls back into censure like it did in the last recession, the bank will call you, they will demand more cash, and if you don't have it, they will sell your stocks at the bottom. And to add insult to injury, those forced sales might trigger the very taxes you were trying to avoid. Risk number 2 is interest rates. S-blocks are variable, so when rates were near zero in Nyansinin Arshideo, this strategy was incredibly cheap. Now that we are in Nyansinin Arshideo and rates are higher, you're paying a lot more to maintain that lifestyle. If your portfolio grows at befintlighting and you pay befintlighting in interest, you're only making befintlighting on that borrowed money. The math only works if your returns stay higher than the bank's interest rate. Risk number 3 is that the laws could change. The OBBBA, but a future Congress could easily decide they want a piece of that step up. In basis, I would even say it is likely that these loopholes get closed or narrowed in the next 10 or 20 years. Peace. I'm not trying to scare you, I'm trying to prepare you. The biggest takeaway here is that the account you choose matters as much as the stocks you buy. The wealthy know how to play the buckets to their advantage. And you should too. If you are still managing all of this on a messy spreadsheet, you are asking for trouble. One tiny mistake in a formula and your whole retirement plan is off by a decade. I personally use professional planning software like Bolden to model out these what-if scenarios. It lets you see the probability of success, so you aren't just guessing with your life savings before you ever think about borrowing against your portfolio. Talk to a professional. The question isn't just can I do this? It's should I do this for my specific family? Most people find that simpler strategies like the befintlighting tax bracket harvest get them most of the way there without the debt. But you need to understand the rules of the game so you aren't the only one paying full price. The wealthy have been using these shields for a long time, and it is time you built your own. If you want to see how a regular couple can pay zero tax on $100,000 of income, I've got a video for that. The world might feel messy, and the tax codes might feel complicated. But there is always a path. I am going to keep digging into these strategies and bringing you the truth so you can stay ahead of the curve. Hit that like button and subscribe if you want to stay in the loop on how to protect your wealth in Nyansinin Arshideo. I am truly grateful for all of you who are taking control of your financial future. It is a long road, but you don't have to walk it alone. I'm going to go check my own brokerage levels and see if I need to do any harvesting today. Stay smart, stay liquid, and keep your head in the game. Oh shit, I almost forgot. Make sure you check your state tax laws too, because they don't always follow the federal rules. Anyway, I'm out for real now. Peace out, guys. Stay safe out there. I'll see you in the next one. Keep building that fortress. Peace. Bye for now. Peace. Seriously. Look at that befintlighting bracket. It's a life changer. Okay, for real. Peace. Bye peace. One last thing. Don't forget to talk to your CPA. I'm a guy on the internet, not your tax man, but the math doesn't lie. Alright, I'm gone. Peace. Bye.